The trade war accelerant. How could escalating trade tensions turn technological disruption into economic catastrophe? Consider this. The United States' average effective tariff rate has reached 23%, a level not seen since 1909. This remarkable reversion to early 20th century protectionism isn't happening in isolation. It's occurring precisely as artificial intelligence begins fundamentally reshaping global supply chains and manufacturing capabilities. This combination creates a potentially dangerous accelerant effect. Trade tensions increase costs and create uncertainty throughout global commerce. AI simultaneously enables rapid production shifts that could destabilize existing economic relationships. Together, they transform manageable economic disruption into something far more severe. The U.S.-China trade relationship illustrates this precarious situation. Last year, these two economic superpowers exchanged approximately $585 billion in goods, with the United States maintaining a $295 billion deficit. This trade imbalance has become politically charged, driving policies that attempt to reduce American dependency on Chinese manufacturing. AI threatens traditional manufacturing equilibrium in several important ways. First, it reduces the labor cost advantage that drove outsourcing originally. Advanced manufacturing increasingly relies on robotics and automation rather than large human workforces. When production becomes highly automated, labor costs represent a smaller percentage of total expenses, diminishing the incentive for locating production in lower-wage regions. Companies like Tesla demonstrate this shift clearly. Their newest manufacturing facilities use AI-powered robotics, requiring minimal human intervention. Location decisions for these facilities increasingly depend on factors beyond labor costs: proximity to markets, technical expertise availability, and supportive regulatory environments. This enables reshoring of previously outsourced manufacturing, particularly for products with complex logistics or intellectual property concerns. The Boston Consulting Group estimates that approximately 20 to 25% of goods currently manufactured in China for American markets could economically relocate to the United States within 5 years as AI and automation advance. This percentage increases to nearly 35% when factoring in current tariff rates. Such a significant shift would fundamentally alter trade patterns established over decades. Reshoring opportunities don't distribute evenly across industries. Electronics assembly, precision components, and advanced materials show the greatest potential for automation-enabled reshoring. Textiles, basic consumer goods, and raw material processing remain more likely to stay in regions with lower costs. This creates uneven disruption across manufacturing sectors. Trade tensions have already shifted production patterns independently of AI developments. Mexico has emerged as a primary beneficiary, with its exports to the United States increasing by 25% since tariff escalation began. Vietnamese manufacturing has similarly expanded, with exports to the U.S. growing 41% during the same period. These shifts occurred primarily through traditional offshoring decisions rather than automation-driven transformations. When AI acceleration combines with these existing trade diversification trends, the pace of change could exceed the adaptive capacity of affected regions. Chinese manufacturing hubs that lose production to both reshoring and diversification could experience rapid employment contractions. Automotive component manufacturing in Jiangsu province has already seen a 15% reduction in employment over 2 years as production shifts to Mexico and automated facilities in the United States. The economic impacts extend beyond manufacturing locations. Global logistics networks developed around specific trade patterns over decades. Shipping companies invested in vessels based on projected trade volumes. Commercial real estate development in manufacturing regions assumed continuing. Industrial growth. Financial institutions structured lending portfolios around expected regional economic trajectories. Rapid shifts disrupt these interconnected systems simultaneously. AI adoption accelerates these production shifts by enabling faster factory reconfiguration. Traditional manufacturing relocations required extensive planning. Modern AI-integrated production systems can reconfigure more quickly, with some facilities capable of switching product lines in weeks rather than months. This technological flexibility makes production shifts more responsive to trade policy changes. Consequently, new economic winners and losers emerge rapidly. Countries positioned to benefit from both trade diversion and AI implementation experience manufacturing booms. Mexico appears particularly well-positioned, with proximity to the U.S. market, established manufacturing expertise, and increasingly sophisticated technical capabilities. Eastern European nations like Poland and the Czech Republic similarly stand to gain from production moving out of Asia, while remaining close to European markets. Countries heavily dependent on export manufacturing, but lacking technical infrastructure for AI implementation, face the greatest risks. Malaysia, Thailand, and parts of coastal China have economies structured around their position in global supply chains. As these chains reconfigure, these regions could experience economic contractions with limited alternative growth sectors immediately available. The destabilization of existing economic relationships creates additional risks. Trade relationships create interdependencies that stabilize international relations despite political differences. As production networks reconfigure, these economic bonds may weaken, potentially reducing incentives for diplomatic cooperation during periods of tension. This creates a feedback loop where economic decoupling and political tension reinforce each other. Currency markets represent another vulnerability. Countries experiencing sudden manufacturing contractions often face currency depreciation as economic prospects dim. This depreciation can trigger capital flight, creating financial instability that compounds economic challenges. When multiple export-dependent economies experience simultaneous pressure, contagion effects become possible. With U.S. tariff rates at 23%, nearly 4 times their level before recent trade tensions, the economic friction in global commerce has increased substantially. These elevated tariffs function as a tax on supply chains, increasing costs throughout production networks. When combined with AI-driven restructuring, they create uncertainty that typically leads businesses to delay investments and reduce hiring. The potential economic consequences extend beyond manufacturing sectors. Consumer prices increase as tariffs and supply chain restructuring raise production costs. Business investment declines amid uncertainty about future trade conditions. Financial markets must reprice assets across regions, experiencing rapid economic transitions. Each effect contributes to recessionary pressure in an already vulnerable global economy. Will current trade tensions and AI acceleration melt away established supply chains faster than economies can adapt, turn technological disruption into economic catastrophe? Consider this. The United States' average effective tariff rate has reached 23%, a level not seen since 1909. This remarkable reversion to early 20th century protectionism isn't happening in isolation. It's occurring precisely as artificial intelligence begins fundamentally reshaping global supply chains and manufacturing capabilities. This combination creates a potentially dangerous accelerant effect. Trade tensions increase costs and create uncertainty throughout global commerce. AI simultaneously enables rapid production shifts that could destabilize existing economic relationships. Together, they transform manageable economic disruption into something far more severe.